Hi friends, this is CA Vardhaman Rakhecha. Welcome to Capital Bridge. In this video, we are going to learn about how did stock market start. And before I tell you that, first let me explain to you what is a share. So to explain that, I will take an example of say a pharma company. There is a pharma company and the total value of the pharma company is say 1 lakh rupees. Means if you go and buy the pharma company in total, you will have to shell out 1 lakh rupees. How did we arrive at this figure? We will subtract from assets, liabilities. Now assets means what? The land, its stock and its debtors, all these assets what it has. From that, if you subtract its creditors, whatever it pays to outsiders, if you subtract that, you get say 1 lakh rupees. Means if you pay 1 lakh rupees, you can buy the business. So now if this pharma company decides that it will go public, means it will list its shares in stock market, then you can buy the entire pharma business at 1 lakh rupees. Now this 1 lakh rupees becomes its market capitalization. So 1 lakh rupees you can buy the entire business, and if it has predetermined that it will have 1000 shares. So 1000 shares, each share's value will be 100 rupees. How we arrived at 100 rupees? 1 lakh rupees was its business value. Divide that by 1000, you get 100 rupees per share value. So if you buy one share, you become a part owner of the business. So basically a share means you get if you buy a share, you become a shareholder in the company, you get a share in the business. So if you buy 10 shares of that company, it had 1000 shares. So if you buy 10 shares, you will become 1% owner of the company. So basically that's what is shares. As a shareholder, an investor typically owns or owes whatever the company owes to the outsider, and the company's profitability or lack thereof will determine the share price of the company. That is, if the company's profit grows, then its share price will also rise. Say that pharma company only, if its performance is improving, then we had earlier the thought that we can buy at 1 lakh rupees even when it was not listed, and if it is doing exceptionally well, then its price will increase. Say it becomes 2 lakh rupees. So then 2 lakh rupees divided by 1000 shares, its share price also will become 200 rupees. So if the company is performing well, then the share price will become higher and you will get at an expensive valuation if you want to buy the share then. And vice versa, if the share of the company will fall down if the business of the company is not doing well. So the commodities market was came into existence during the Middle Ages, whereas the stock market was introduced in the 16th century around. So how was the stock market introduced? Let us understand that. Back in 1600s, the Dutch, British and the French government all gave charters to companies having East India in their names. Now the sea voyages that brought back the goods from the east were extremely risky. One of the reason was Barbary pirates, and on top of that there was extreme weather crisis which was there and poor navigation also. So because of all this, to counter the risk, they decided that they want some of the investors who will invest in their business so that their fortune can be saved, and they offered the investors a share in the business in consideration of investment. And there were a lot of people who gathered their saving together and gave them the money in return for a share in the business and formed joint stock companies. So originated by the Dutch, joint stock companies became a viable business model and it was extremely successful, and those people who invested in this business got huge profits. Like this, in 1602, the Dutch East India Company issued the first paper share and the first stock exchange was born in Amsterdam, called the Amsterdam Stock Exchange, and this Amsterdam Stock Exchange became the medium for the people to buy, sell and trade their shares conveniently. And this idea was so successful that this trading in shares grew to other powerful maritime countries also, such as England, France, USA and finally India. So how did the stock market was born in India? One of the most popular stock exchange, Bombay Stock Exchange, was born in 1875 and it was started by Premchand Roychand, Rajasthani Jain merchant in 1875. While BSE Limited is now a synonym with Dalal Street, it was not always so. In the 1850s, 5 stockbrokers gathered together under a banyan tree in front of a Mumbai town hall where presently Horniman Circle is located now. As the number of dealers increased, the Bombay Stock Exchange continued to operate out of a building near the town hall until 1928, and the present site near Horniman Circle was acquired by the exchange in 1928 and a building was constructed and occupied in 1930. The street on which the site is located came to be called as Dalal Street, in Hindi meaning broker street. Due to the location of the exchange, it was so named as Dalal Street. And finally, on 31st August 1957, the BSE became the first stock exchange to be recognized by the Indian government under the Securities Contract Regulation Act. Construction of the present building, the Firoze Jijibai Towers at Dalal Street Fort area, began in the late 1970s and was completed and occupied by the BSE in 1980. Initially named the BSE Towers, the name of the building was changed soon after the occupation in memory of Sir Firoze Jamshedji Jijibai, chairman of the BSE since 1966 following his death. In 1986, the BSE developed the S&P BSE Sensex Index, giving the BSE a means to measure the overall performance of the exchange. And in 2000, the BSE used this index to open its derivative market, trading S&P BSE Sensex future contract. The development of S&P BSE Sensex options along with equity derivatives followed in 2001 and 2002, expanding the BSE trading platform. The BSE is the 8th largest stock exchange in the world and Asia's oldest stock exchange, with an overall market capitalization of more than 276.13 lakh crores as of Jan 2022. And there are 2 main stock exchanges in India that make up the stock market. They are the Bombay Stock Exchange and the National Stock Exchange. Popularly, these 2 are called as BSE and NSE. Besides these 2 exchanges, there are many other regional stock exchanges like Bangalore Stock Exchange, Madras Stock Exchanges that are more or less getting phased out and don't play any meaningful role as of now. So how does stock market function? Now, as we have garments market where garments are bought and sold. Similarly, we have stock exchange, that is stock market or share market, where shares are bought and sold by the individuals or by the institutions, etc. But how does this process flow? For that, let us understand the participants in the stock market. Now, participant, if I say first participant, if I want to tell, is the most important, that is the regulator. Now, if you see for Indian cricket, who is the regulator? BCCI. BCCI controls the Indian cricket completely. And similarly, we have for stock market SEBI, Securities Exchange Board of India. Now, this SEBI will control the stock market in India and it plays a vital role in protecting the investors' interest as well as it ensures fairness in the market. Now, next you have is stock exchange. What does this stock exchange do is that it provides a facility, that is it gives a trading platform to the stockbrokers and the investors to transact in securities electronically. And then we have another participant, that is the company itself. Now what does company do is that if it wants to get listed in the stock market, that is if the company wants to go public, and if it wants public to be the owner of their company or give the funds to the company for carrying out its business, then it will launch its initial public offering, that is IPO, and then it will get listed in the company. And once it is listed, then the people can trade in its shares. And fourth participant is the investors and the traders who will invest in the company or trade in the company's shares. So if the securities are bought from the perspective of long-term horizon, then it is considered as investment, otherwise it is considered as trading. And then there are two types of investors. One, you have retail investors. So retail investors are the common people like you and me, and others are the institutions like banking companies, then you have asset management companies, insurance, etc. Next is market intermediary. So the first market intermediary is the broker. That is the one through which you will place your order. So suppose you want to buy 1000 shares of Reliance, you will buy the shares through your broker, that is say Upstocks or Sharekhan. So this stockbroker will have a broking license and will follow the guidelines prescribed by SEBI. So order you can place of buying shares through your mobile also nowadays, or even your computer. And if you are not that tech friendly, then you can also call and trade in some of the broking companies also provide you that facility. And after the order is placed with your broker, then the second market intermediary comes into picture, that is the stock exchange itself. So stock exchange is the place which provide the exchange facility between the buyer and the seller of the shares, because suppose you want to buy 1000 shares of Reliance, there has to be someone who has to sell the same number of shares. So exchange will be the one who will match this, who will find out the person and he will match your trade. So in the exchange the orders are matched. So after the trade is matched and executed, now these trade will go to clearing house. That is, you have two clearing corporations in India, NSCCL and ISCCL, and these clearing corporations will ensure that the one who has sold the shares, his shares will be debited and the amount in his account will be credited, because his number of shares should reduce and he should receive the amount for the shares which he has sold. So that will be taken care of, and vice versa of the purchaser, that is one who has acquired the shares, in his account shares will be increased, credited, and the amount will be debited from his account for the purchase what he has done. So clearing corporation ensures that the trades are being cleared. And now you have depository. So depository is the one which is like a locker where your shares are stored digitally. Presently there are two depositories in India, that is NSDL and CDSL. So your broker and the depository are integrated, and when you do transaction through your broker, it will be reflected by your depository in the demat account, which you can see from your broker's terminal. And another important intermediary is the bank itself, because when you want to start investing, you have to invest money in the shares. For that you have to transfer funds to your broker account. So that will be done through your bank account. One bank account will be linked with your broker, and you can deposit money in your broking company, or you can withdraw it from there using your bank account, and all the money whenever you transfer will be credited or debited from your bank account, and all the dividends also which you receive from the company will be credited directly to the bank account which is being linked with the broker. Now to conclude the process in a nutshell, first you will transfer the funds from your bank account to your stockbroker, and then you will purchase the shares through your stockbroker. Once you purchase the trade, the same will be matched and executed in your stock exchange, which will ultimately be cleared by the clearing corporation, and once it is cleared, it will be reflected in the demat account, that is through your depository. And if you want to sell the shares and again transfer the fund, you can withdraw it from your broker's account, which will be again the funds will come back to your bank account. So thank you guys. I hope you liked our video. In case you liked it, do like it, share it and subscribe to our channel. Thank you.